Some hedge fund managers make more than $1 billion a year, while managing more money than the entire GDP of some European nations. They're also constantly in the media for illegal scandals, insider trading, market manipulation, and of course, Ponzi schemes. And even our good friend Jeffrey Epstein supposedly had one. Hedge funds are some of the most powerful financial institutions on the planet. They control trillions of dollars, influence asset prices with their trades, and shape global finance in ways most people don't even realize. So what actually are hedge funds? How do they work? How do you join one? And how do they manage to make money even when they lose?
What?
By the end of the video, you'll understand exactly how hedge funds work and more. Let's go. In a sentence, a hedge fund takes money from rich people and institutions and invests it in a wide array of assets. Pretty simple. Except these guys are meant to be the market wizards. Unlike traditional funds, these guys are pretty much expected to make money and maximize their returns in any market condition. Markets on a tear, they better be beating it. Markets shitting the bed, they better have predicted it and set themselves up to make money in advance. In fact, the number one unwritten rule of hedge funds is never lose money. Now, there's also some other key characteristics that make hedge funds special. One, they're only for the wealthy. Unlike mutual funds, hedge funds are not open to the public. In fact, they can only take on accredited investors, which typically means having a net worth of at least $1 million or an income of $200,000 a year. Two, they're lightly regulated and far more secretive. They're the cowboys of finance. They operate under far fewer rules compared to traditional investment funds, and they don't have to disclose their trades until they file their 13F reports once a quarter. Three, aggressive and high-risk strategy. Unlike mutual funds that mainly buy stocks and bonds, hedge funds are able to use short selling, leverage, derivatives, and algorithmic trading to help maximize profits. A few quick definitions because these are important to understand. To understand short selling, I'm going to use a simplified example. Let's say you think Apple stock is going to go down in the future, so you call your broker and ask to go short one share of Apple stock. They take a share of Apple from someone else's portfolio, sell it, and give you the cash. Now you have $100 cash. But you owe your broker one share of Apple. Tomorrow, Apple's stock tanks and goes down to $80. You now decide to cover your short, buying back the share of Apple at the new market price of $80 and return it to your broker. Congrats, you've made a profit of $20. Leverage is simply using debt to make your positions even larger and therefore your trades even more profitable. Now, if your trade goes wrong, you'll obviously lose even more money than you actually have. I like Buffett and Munger's attitude towards leverage. If you're smart, you don't need it. And if you're dumb, you shouldn't use it. Derivatives are financial products whose value is based on an underlying asset. You might have heard of these before. The common ones include futures, options, forwards, and swaps. 4. Fees. Because of their promise to never lose money and make outlandish returns, the typical fee structure of a hedge fund is known as 2 and 20, as in a 2% management fee and 20% of profits. And this is how hedge funds always make money even when they lose. They take 2% whether or not they made a single profitable trade that year. Take Citadel, for example. They manage around $65 billion in capital. The 2% fee they charge brings them in $1.3 billion a year. Let's now move on to hedge fund trading strategies. This is the OG hedge fund strategy. Bet on the winning stocks and short the losers. It's the OG strategy because the original idea for hedge funds was an investment fund that hedged their bets. So how does it work? Let's say a hedge fund thinks that Microsoft is undervalued and Tesla is overvalued. They'd buy Microsoft stock and short Tesla stock at the same time. Now, if they're wrong in either of these specific cases, they'd still lose money on their positions. But what they're trying to hedge against is market risk. The risk that the entire market crashes. Because if the market crashes, while their Microsoft position goes to shit, their Tesla position would make a killing. Global macro hedge funds trade based on big picture economic trends, things like inflation, interest rates, wars, geopolitics, and even election. They'll use stocks, bonds, currencies, and commodities to profit in shifts in global markets. Here's a pretty crazy example for you. So basically the UK had an agreement with Europe to keep the British pound within a fixed exchange rate band against the German Deutschmark, but high inflation and interest rates in the UK made it difficult to maintain. Soros's hedge fund, Quantum Fund, borrowed billions of pounds and immediately sold them for Deutschmarks, expecting the pound's value to fall. This put tremendous pressure on the pound, and on Black Wednesday in 1992, the UK was forced to break their agreement and the pound plummeted in value. How much did Soros make from this trade? $1 billion. Quant hedge funds use AI, algorithms, and machine learning to sometimes make millions of trades per day. These funds try to find tiny inefficiencies in the market and exploit them faster than any human ever could. Ever heard of Jim Simons? Well, you probably should have, because his average annual returns are almost triple that of Warren Buffett's. He was a freakish mathematician that worked for the NSA as a code cracker during the Cold War, before starting his hedge fund called Renaissance Technologies. His flagship Medallion Fund earned an average annual return of 66% and is the most profitable hedge fund in history. If you invested $1,000 in his fund back in 1988, today it would be worth around $140 million. Event-driven hedge funds bet on corporate events. Mergers, bankruptcies, lawsuits, earning reports, etc. They try to predict how markets will react to major news and position themselves accordingly. For instance, when Elon announced he was buying Twitter, a bunch of hedge funds shorted Twitter stock, betting the deal would fall apart. Others went long, buying as much stock as possible, which made millions when the deal eventually closed at $44 billion. Now, this was by no means an exhaustive list. These are just some of the main strategies the majority of hedge funds will employ. Here's a more extensive list if you guys wanted to pause the video and have a quick read. Otherwise, I think it's time to move on and dive into the big dogs. If there's one name that dominates modern hedge funds, it's Ken Griffin. Placing his first ever trade as a Harvard freshman and using a satellite dish outside his window in order to get live stock data, he started trading at 19 years old with $256,000 from friends and family. By the time he graduated, he had amassed a couple $1 million and started his hedge fund, Citadel, which now manages over $65 billion. And Kenny Boy isn't just good at making money, he's good at keeping it. For instance, in 2022, while the markets were bearish due to inflation, rising interest rates, and geopolitical instability, Citadel's flagship fund gained around 38%, earning $16 billion, the largest single-year gain for any hedge fund ever. He also spent a cheeky little $500 million for a couple of paintings in 2015. You've probably heard of Ray Dalio, perhaps from podcasts, YouTube videos, or even his books, which I've loved. He's the founder of Bridgewater Associates, the largest hedge fund in the world, managing over $125 billion. He created what's known as the all-weather portfolio, an investing strategy designed to perform well in any economic condition. He's also famous for his culture of radical transparency, where even the lowest of employees at Bridgewater are expected to call out their bosses in meetings. Every single conversation at work is recorded and analyzed so everyone can be on the same page. He genuinely believes the best results come from a culture of brutal honesty. If you've ever watched Billions, you've basically already met Steve Cohen, because Bobby Axelrod was loosely based around this guy. Cohen is one of the most aggressive, risk-taking hedge fund managers of all time. His former firm, SAC Capital, made billions in the 90s and 2000s. The only issue? They were doing it illegally. In 2013, SAC were fined $1.8 billion for insider trading, one of the biggest financial scandals in history. The firm was shut down, traders were arrested, but Cohen himself never personally convicted. Instead of disappearing, Cohen did what billionaires do. He paid his fines, rebranded, and started another hedge fund, Point 72. And guess what? It's now managing over $30 billion and growing. Oh, and he also bought the New York Mets, because when you have that much money, why not? Bill Ackman runs Pershing Square Capital, an activist hedge fund that doesn't just invest, it forces companies to change. You might have heard of his most famous public battle with other hedge fund billionaire Carl Icahn. In 2012, Ackman shorted $1 billion worth of Herbalife stock, claiming the company was a pyramid scheme. And then, being an activist investor, not only did he short it, but he went to TV, lobbied regulators, and gave hours-long presentations trying to destroy Herbalife. And that's when Icahn stepped in. Icahn bet against Ackman, buying up Herbalife stock and publicly ridiculing him. The result? Ackman lost hundreds of millions of dollars on his short position, and eventually backed out of the fight, while Icahn made about $1 billion. To his credit, Ackman's made some legendary trades too. In 2020, he turned $27 million into $2.6 billion by betting the markets would crash due to COVID. There's a bunch of other notable examples too. Jim Simons and George Soros, who we briefly touched on earlier, Stanley Druckenmiller, who worked with Soros to break the Bank of England, and one of my personal favourites, Paul Singer, who forced Argentina, yes, the country, to hand over a naval vessel when they wouldn't pay up on the debt they owed him. Now, for every hedge fund success story, there's a fund that collapses so badly they leave Wall Street with their tails tucked and reputations shattered. Let's dive into the dark side of hedge funds. In the 90s, Long-Term Capital Management, or LTCM, was the hedge fund. Founded by this guy John Merriweather, a former Solomon Brothers trader, and staffed with supposedly some of the most brilliant financial minds on the planet, we're talking Nobel Prize-winning economists, these guys thought they had cracked the market. Their approach? Used complex mathematical models to make tiny, ultra-safe profits on trades they believed could never fail. And at first, it actually worked. From 94 to 97, they were delivering huge returns, and Wall Street couldn't throw money at them fast enough. Remember what we said about leverage before though? These guys were levering up their trades 30 to 1. So for every dollar they had, which was around 100 billion, they borrowed 30 more to trade with. And then, in 1988, it all went catastrophically wrong. Russia defaulted on its government debt they had never predicted possible, and their trading models began bleeding billions. The scary part is that because they became so big, they were interconnected with all the major banks, and so their losses and eventual collapse threatened to destroy the entire financial system. The Federal Reserve had no choice but to bail them out for $3.6 billion. Long-term capital morons. Anyway, I didn't want to spend too long focusing on Wall Street morons, but if you like this kind of story, leave a comment below and I'll make more videos focused on this stuff. Otherwise, it's time to move on to how to join a hedge fund. So unfortunately for most of us peasants, it starts with going to one of these universities. Basically Ivy League or don't bother. So, what do you study? There's the traditional route of finance, economics, or accounting, or there's the newer route, which has been popularized due to the rise in algorithmic trading at quant funds, which is maths, computer science, physics, or statistics. Typically, hedge funds won't hire people straight out of uni. They'd much rather candidates with some experience. The most common path being something like get hired at a top investment bank, Goldman, Morgan Stanley, or JP Morgan, work in investment banking or sales and trading for 2 to 3 years, and then network aggressively and move into a hedge fund as an analyst. This is known as the Wall Street pipeline. It's like hedge funds will use investment banking as the boot camp before you get to earn the real money. If you want to know how hard that boot camp is, go check out my video on investment banking. Honestly, there's 2 main skill sets for hedges these days. You're either a gun investor or you're a freakish mathematician and an engineer. So pick one. If you're going down the investing route, you need to be a master at financial modeling, valuation, and industry research. This means knowing how to read balance sheets, analyze companies and industries, and have the balls to predict which stocks will rise and fall. Ideally, you've got a bit of a track record, trading your own and/or friends and family's money to prove your skill set. If you're going down the nerdy route, you're going to need PhD level math skills coupled with the ability to turn your statistical models into automated trading algorithms that make money. Again, something you should probably try and build on your own to prove your skill set. This one's arguably one of the most difficult, but the fact of the matter is, hedge funds don't post job listings on LinkedIn. If you want to work at one, you need connections. Some hedge funds quite literally only hire analysts based on referrals. That's how secretive and exclusive the industry is. Hedge fund interviews are notoriously brutal. Let's say you're going for a fundamental role as an analyst. Expect some questions along these lines. If I give you $100 million to invest right now, what's your first trade? They want to see if you have conviction and can justify a high-stakes decision. They might follow up with, what are the risks and what would make you change your mind? A company's stock drops 30% overnight. What's your thought process before making a trade? Hedgies love reaction-based questions. They want to see if you can quickly assess risk. You should immediately ask, what caused the drop? Earnings miss? Market panic? Fraud allegations? Is it an overreaction or justified? You're tracking 2 companies in the same industry. One is a PE ratio of 10 and the other 20. Which one do you invest in? Trick question. You need more information. And what about quant-style questions? You have a coin that flips heads 51% of the time and tails 49%. Would you bet on it? How would you structure your bets? This is a probability-based trading question. They want to see if you understand expected value and bet sizing. Smart answer? Yes. But you should bet small and consistently to maximize returns and minimize variance. You notice a certain stock trades higher on Fridays. How do you determine if this pattern is real? They want you to think like a quant. Steps? Gather historical data, maybe 10 plus years of price movement. Test statistical significance. Is this actually a pattern or just noise? Control for external factors, earnings, options expirations, etc. Check for profitability. Can you profit from it after transaction costs? And finally, a stock has a 20% chance of going up 50%, a 50% chance of staying flat, and a 30% chance of dropping 40%. Do you invest? Again, expected value. 0.2 times 50%, plus 0.5 times 0%, plus 0.3 times negative 40% equals 10% expected value. We take away the average market return of 12% because we only care about alpha, or beating the market, and we get an adjusted EV of minus 2%. So no, we don't invest. Overall, if you're in a hedge fund interview, they expect zero fluff. They don't care about your hobbies, they don't care about your passion for finance, they might care about who your dad is, but really, all they care about is, can you make them money? So, what do you guys think? Was there anything about hedge funds I didn't answer that you'd like answered? Leave a comment below, and if there's enough interest, I'll consider making a second video on hedge funds. Otherwise, I was thinking of delving into the lives of lawyers for my next video. Please remember to like, comment, and subscribe. Let me know what you liked and what you didn't. I'm always trying to improve. Thanks for sticking around and watching the video. See you next time.